All right, let's dive into inheritance tax in the UK. Now, I've got to admit, this is one of those topics I've always meant to get a better grasp on, but it always seemed, a bit daunting. So I've brought in an expert to help us both navigate these waters. Maybe we can even demystify some of this stuff. What exactly is inheritance tax, and why should we care about it?
Well, inheritance tax, or IHT as it's often called, it's essentially a tax that's levied on the value of a person's estate when they pass away. And it's definitely something to be aware of, especially if you're planning to leave assets behind. IHT could really impact how much of your wealth actually makes it to your loved ones.
So it's not just about the money itself, but about the potential tax implications
Mm,
for those who inherit it.
exactly. And understanding those implications can really help you make better decisions about, how you manage your assets and plan for the future.
That makes a lot of sense. Now, I've heard that inheritance tax has been around for centuries in the UK. Is that true?
It is, yeah. The concept of taxing inherited wealth, it has a surprisingly long history here in the UK.
Centuries? Really? That's fascinating. I had no idea. What did those early forms of inheritance tax look like?
Well, before we had the modern inheritance tax system that we know today, there was this whole complex system of taxes related to inheriting property. Things like probate duty, which was a tax on wills dating back to 1694, and legacy duty, which was based on your relationship to the person you inherited from. They even had something called account duty, designed to prevent people from giving away their assets before death to avoid those taxes.
Wow, 1694. It seems like the government has always had a keen eye on inheritances, huh? So when did things start to resemble the inheritance tax we have today?
Well, the modern system, it really began to take shape in 1894 with the introduction of estate duty. And this new tax really consolidated many of those earlier, more fragmented taxes. It focused on the overall value of the estate rather than individual bequests.
So like a shift from taxing the individual slices of the pie to taxing the whole pie itself.
That's a great way to put it. And estate duty, it evolved over time, became a bit more progressive in its rates, with higher percentages applied to larger estates. At one point, the top rate of estate duty actually reached a staggering 85%.
85%. Wow, that's a huge chunk of change. I'm guessing things have calmed down a bit since then.
Yeah, they have indeed. Estate duty was eventually replaced by capital transfer tax in 1975, which broadened the scope to cover different types of wealth transfers, not just inheritance, but that didn't last very long. By 1986, during the Thatcher era, it was renamed to inheritance tax, and the focus shifted back primarily to transfers upon death.
Okay, so we've gone from this jumble of taxes to estate duty, then a brief fling with capital transfer tax. And finally, we've landed on the inheritance tax that we have today. It's been quite a journey.
Yeah.
So let's dive into what this modern inheritance tax actually looks like. What exactly counts towards your estate for IHT purposes?
That's a good question. You see, it's not just about the cash you have sitting in your bank account, your estate for IHT. It actually encompasses all your assets, including your property, investments, valuables, even certain gifts you might have made in the 7 years leading up to your death.
Wait, gifts. So if I were to give a valuable painting to my daughter a few years before I pass away, that could still be subject to inheritance tax.
That's right. If the total value of those gifts exceeds certain limits, they can actually eat into your tax-free allowance, which is known as the nil rate ban.
Nil rate ban, that sounds important. What is that exactly, and how does it work?
So the nil rate band, it's essentially a threshold below which your estate is completely exempt from inheritance tax. Currently in the UK, that threshold sits at £325,000. So if your estate is valued at or below that amount, no inheritance tax is due.
Okay, that makes sense. So anything above that 325,000 pounds gets taxed.
Yeah.
But at what rate?
The standard rate is 40% on the value exceeding that nil rate band. So let's say your estate is valued at £500,000. You would subtract that £325,000 nil rate band, leaving £175,000 subject to that 40% tax.
So in that scenario, the inheritance tax bill would be a whopping 70,000 pounds.
That's right. But it's not always that straightforward. There are various factors that can actually reduce or even eliminate that IHT liability.
Like what?
Well, for instance, estates left entirely to a spouse or civil partner are completely exempt from IHT, meaning you can pass on your entire estate to your partner without any tax implications. And since 2007, married couples and civil partners have actually had the option to transfer their unused nil rate band to each other. So if one spouse passes away without using their full allowance, the surviving spouse can inherit that unused portion, effectively doubling their own nil rate band.
Oh, wow. That's a pretty significant benefit for couples, right? Allowing them to potentially shield a much larger amount from inheritance tax. What about charitable donations? Do those have any impact on IHT?
Absolutely. Estates left entirely to charities are also exempt from IHT. And if you leave at least 10% of your net estate to charity, the IHT rate on the remaining portion is reduced from 40% down to 36%.
So giving to charity doesn't just benefit a good cause. It can also, like, lessen the tax burden on your heirs.
Yeah.
That's a fantastic incentive. Now, I know there are some special exemptions as well, right?
You're right. One particularly notable one is the blue light exemption, which was originally designed for members of the armed forces who died on active duty. But it's actually been expanded in recent years to include individuals working in emergency situations.
That's interesting. Who else would that cover?
Well, for example, it was applied to the estates of care workers who tragically lost their lives during the COVID-19 pandemic, recognizing the extraordinary risks they took to serve and protect others.
That's incredibly touching. It's a small way to honor their sacrifice. So we've covered estates below the nil rate band, those left to spouses or civil partners, those left entirely to charities, and this special blue light exemption. But what about situations where, none of those apply and the estate exceeds the nil rate band?
Well, that's where things can get a bit more complex. That standard 40% rate kicks in for any amount above the nil rate band. And there are additional considerations, especially when it comes to property, but that's something we can delve into further in the next part of our deep dive.
This is all starting to make a lot more sense now, but I have a feeling there's a lot more to uncover. We'll be back soon with part 2 of our inheritance tax deep dive, where we'll explore those complexities in more detail and delve into the residence nil rate band, which I'm particularly curious about. Stay tuned. Welcome back to our deep dive into inheritance tax in the UK. In the last part, we uncovered that long history of IHT, and we explored some of the basics like the nil rate band and the various exemptions. It's fascinating how this tax has evolved over centuries. You mentioned that things get a bit more complex when it comes to property.
Right.
I'm particularly curious about this residence nil rate band, or R&RB, that we touched upon briefly. What exactly is it, and how does it impact inheritance tax on property?
Well, the R&RB, it's a relatively recent addition to the IHT landscape, introduced back in 2015, and it's specifically designed to reduce the IHT burden when a family home is passed down to direct descendants.
Descendants, meaning like children and grandchildren.
Yes, but it also includes stepchildren, adopted children, and even their spouses or civil partners. The goal is to make it easier for families to pass down the family home, without facing a huge tax bill.
So how much of a tax break does the R&RB actually provide?
Well, it started at £100,000 back in 2017, and it's been gradually increasing every year since. Currently, it stands at £175,000.
Okay, so that's on top of the regular nil rate band of £325,000.
Yeah.
So that means like a significant portion of a family home could potentially be shielded from inheritance tax.
You got it. And just like the regular nil rate band, this benefit doubles for married couples and civil partners. So potentially, a couple could pass down a home worth up to £1 million without incurring any inheritance tax.
£1 million. That's incredible. It sounds like the R&RB is a real game changer for families looking to pass down their property. But what if, like, the house isn't worth that much, or the parents downsized before they passed away? Do they lose out on that R&RB benefit?
Not necessarily. The rules actually account for situations where someone downsized or ceased to own a residence after July 2015. As long as they left assets of equivalent value to their direct descendants, they can still claim a portion of the R&RB. It adds a level of flexibility to the system.
That makes sense. It wouldn't be fair to, like, penalize people for downsizing or moving into a smaller property later in life.
Yeah.
Now, earlier, we talked about gifts and how they can be factored into that inheritance tax calculation. But our source material also mentions something called pre-owned asset tax, or POAT. What's that all about?
So POAT, it's a separate but related concept introduced in 2004. It applies to situations where you dispose of an asset, but you continue to benefit from it.
Can you give me an example?
Sure. Imagine, for instance, selling your home to your child at a below-market price, but continuing to live there. POA is designed to prevent individuals from avoiding inheritance tax through those sorts of arrangements.
So it's like a safeguard to make sure that people can't simply give away assets to avoid IHT.
Precisely. It closes a potential loophole, ensures that the tax system is applied fairly.
That makes a lot of sense. As we've been exploring all these intricacies of IHT, it's become clear that, careful planning is crucial. But where does someone even begin with estate planning?
Well, the first and most important step is seeking professional advice from a solicitor or a financial advisor who specializes in estate planning. They can provide personalized guidance based on your individual circumstances.
So finding an expert is key. But what about those do-it-yourself will kits you see advertised? Are those ever a good option?
While they might seem appealing, due to their convenience and lower cost, I would generally advise against using DIY will kits, especially for more complex estates. You see, there are often nuances and specific legal requirements that can easily be overlooked, which could then lead to unintended consequences, or even challenges to the validity of your will.
That's good to know. It's better to be safe than sorry when it comes to something as important as your will.
Absolutely. A solicitor can help you draft a will that clearly outlines your wishes and ensures that your assets are distributed in a tax-efficient manner. They can also advise on other estate planning tools, like trusts, which can provide additional flexibility and control over how your assets are managed and distributed.
Okay, so professional advice is paramount. A comprehensive will is essential, and exploring tools like trusts can be beneficial. What about charitable giving? We talked about its impact on IHT earlier, but does it play a broader role in estate planning?
Yes, it does. Charitable giving can be an important aspect of estate planning. It allows you to support causes you're passionate about, while potentially reducing the tax burden on your heirs.
It's like weaving your values into your financial decisions. You're not just thinking about who gets what. You're considering the impact you want to have on the world.
Exactly. It's about aligning your financial legacy with your personal values.
This has been incredibly insightful. It's amazing how what initially seemed like, a dry and complicated topic has become so engaging. But hold on, there's more to come. In the final part of our inheritance tax deep dive, we'll tackle those controversies we touched on earlier, exploring the debate about the fairness of IHT, and examining potential future directions for this tax in the UK. Stay with us. Welcome back to the deep dive. We're wrapping up our exploration of inheritance tax in the UK. In previous parts, we journeyed through the history of IHT. We delved into its complexities. We even, explored practical estate planning considerations. But now it's time to tackle the elephant in the room, the controversies surrounding IHT and the debate about its fairness. Earlier, we briefly mentioned the Queen's inheritance and the use of tax-exempt trusts by, wealthy families. And these examples spark some questions for me about, whether this system is truly equitable. Is it tilted in favor of the already wealthy? And if so, is it time for a major overhaul?
Those are very valid questions, and ones that are frequently debated. I think one of the main criticisms leveled at the current system is that it allows significant wealth, particularly within, the upper echelons of society, to be passed down through generations with minimal tax implications.
You're talking about like elaborate trust structures and legal loopholes that enable some families to shield vast estates from inheritance tax.
Precisely. The argument is that these mechanisms, they perpetuate wealth inequality, giving a select few an unfair advantage that most people could only dream of. The late Duke of Westminster's estate, for example. It was largely shielded from IHT through a complex network of trusts.
So critics argue that the current system allows a concentration of wealth at the top, which then has, broader societal consequences.
Exactly. They contend that this concentration of wealth, it impacts everything, from access to education and healthcare to social mobility and economic opportunity.
It raises fundamental questions about fairness and whether everyone is truly playing on a level playing field when it comes to wealth and inheritance.
And those questions have, real-world implications. Some argue that the revenue that's lost through these exemptions and loopholes could be used to fund essential public services or provide relief to those struggling financially.
Okay, so there's a strong case to be made for reform.
Yeah.
But what about the other side of the argument? What are the counterpoints against changing the current system?
Well, those who support the existing system often emphasize the importance of protecting privacy, particularly for beneficiaries who might be, minors or vulnerable adults. They argue that forcing greater transparency around trusts could expose these individuals to unwanted scrutiny or even harassment.
Privacy is definitely an important consideration. What other arguments do they make?
Another common argument is that these tax breaks and trust structures are crucial for supporting businesses and preserving jobs. They suggest that excessive taxation could discourage investment and entrepreneurial activity, potentially hindering economic growth.
So it's a balancing act then between addressing wealth inequality
Yeah.
and fostering economic prosperity.
That's the crux of the debate. And there's also the perspective that individuals who have, worked hard and accumulated wealth have the right to pass it on to their heirs without excessive government interference.
It's a complex issue with valid points on both sides. It boils down to, different perspectives on the role of government, individual rights, and the overall well-being of society.
You've hit the nail on the head. And these aren't just theoretical debates. They have a real impact on people's lives and the future of our society.
I think we've done a good job of exploring these complex issues today. We've gone from the historical origins of inheritance tax to its practical implications, and now we've delved into the heart of the controversy surrounding it. For our listeners, we hope this deep dive has been more than just an informative session about a tax. We hope it sparked some deeper thinking about fairness, about wealth, and our collective responsibility to create a more equitable society.
We've equipped you with the knowledge and the context to form your own opinions on these very important issues.
And as we wrap up, we encourage you to continue exploring, questioning, and engaging in these conversations. The future of inheritance tax and its impact on our society is something we'll all shape together. Thanks for joining us on The Deep Dive.